Welcome to part 2 of File 001. Let's continue unraveling how this scheme that billionaires use to skip millions in taxes really worked. Consider the arithmetic. 2003. Musk invests $6.5 million to become the largest shareholder of a tiny electric car startup nobody takes seriously. He files his elections. He locks in his cost basis. Fast forward to 2021. Tesla peaks above $1,200 per share. Musk's stake is worth, at that peak, over $300 billion, thousands of times the original investment. And because the election was filed in the early days, the IRS's claim on most of that growth is capital gains, only realized if he sells. Layer 1, we just proved, means he doesn't sell. Layers 1 and 2 stacked mean Musk acquired a paper fortune of hundreds of billions of dollars, and the IRS has collected almost naught on it. Pause for a second. Let that land. Layer 1, he never sells, so he never realizes a gain. Layer 2, he acquires the shares in a structure where, even in principle, the tax liability is deferred until he sells. Combine them, and you have a man whose wealth compounds in a vacuum. No tax friction, no forced sales, no realization events. But there's a problem. Loans have to be paid back. And when he eventually does pay them back, the IRS, in theory, should get its turn. That's where Layer 3 comes in. And Layer 3 is where this playbook gets genuinely breathtaking. Layer 3. The architecture. Wealthy individuals do not hold their assets in their own names. That would be a catastrophic mistake. Assets held directly expose you to lawsuits, divorce, estate tax, public disclosure, and creditor risk. So the ultra-wealthy build what is called an entity architecture, a layered structure of trusts, LLCs, holding companies, and in some cases, foundations. Musk's publicly known structure includes an entity referred to in court filings as the Elon Musk Revocable Trust, which holds a significant portion of his Tesla and SpaceX shares. A revocable trust is a legal wrapper. During your lifetime, you control it. You are the trustee. You make every decision. But on paper, the shares are not owned by you. They are owned by the trust. Here is why the wrapper matters. Income generated inside the trust can sometimes be directed to the trust's tax brackets or deferred through distributions. Loans taken by the trust against trust-held assets are debts of the trust, not the individual. Assets held by the trust can pass to beneficiaries without going through probate. And, critically, in the event of the individual's death, the trust continues. The assets never legally change ownership because they were never legally in the individual's name to begin with. This matters more than you can imagine, and we'll see why in Layer 4. Alongside the revocable trust, billionaires use a more surgical tool called a grantor retained annuity trust. In the industry, they call it a GRAT. A GRAT lets you transfer assets that are about to explode in value to your heirs, while paying almost zero estate or gift tax. Here's the mechanics simplified. You transfer assets into the GRAT. The IRS calculates an assumed rate of return called the Section 7520 rate. Historically, it's been very low, sometimes under 2%. If your assets grow faster than that rate, say, like Tesla in 2020, everything above that rate passes to your heirs outside of your taxable estate. Mark Zuckerberg's family used this with pre-IPO Facebook shares. Sheldon Adelson used it with Las Vegas Sands. Their heirs saved billions in estate tax, legally. For the most sophisticated players, the architecture extends beyond U.S. borders. This is where structures like Cayman Islands holding companies, Luxembourg investment vehicles, and Delaware statutory trusts enter the picture. Each jurisdiction offers a specific legal feature. zero capital gains tax, strong asset protection, privacy, or flexibility in how foreign income is treated. The Panama Papers and Pandora Papers leaks, published by investigative journalists, documented thousands of these structures in detail. The leaks confirmed what tax lawyers had been quietly building for decades. We won't go further into these in this case file. Most of them are not used by Musk specifically, but they are the next layer most ultra-wealthy families reach for, and they will be the subject of case file number 3. Step back and look at the stack. Layer 1. He borrows against shares, tax-free liquidity. Layer 2. He acquires those shares inside a structure that defers tax until realization. Layer 3. He holds the whole arrangement inside an entity architecture that protects, shelters, and controls flow. Already, we've mapped a legal pathway for billions of dollars of growth to pass through his life while the IRS stands aside. But we still have the original problem. Loans have to be repaid. Eventually, something has to give. Unless the thing that gives is him. Layer 4. Die. There is a single paragraph in the U.S. tax code that transforms everything you just learned from aggressive tax deferral into permanent, generational tax elimination. It is called the step-up in basis. Internal Revenue Code Section 1014. Here's how it works. When you die, the assets in your estate are not sold. They are transferred to your heirs. On the day of transfer, the IRS performs what is effectively a reset. Your original cost basis, what you paid for the asset, is erased. It is replaced by the current market value on the date of death. Every dollar of unrealized capital gain accumulated over a lifetime evaporates. Not taxed, not deferred, erased. Let that sink in. Elon Musk's Tesla shares, acquired for roughly $6.5 million, sitting on hundreds of billions of unrealized gains, held inside a trust structure with loans outstanding against them. When he eventually dies, the step-up in basis resets the cost basis of those shares to their value on the day of death. His heirs can then sell those shares immediately at that new stepped-up basis, generating zero capital gains tax. The proceeds of that sale can be used to pay off every outstanding loan. And the entire multi-decade compounding of wealth, every dollar of gain, every share appreciation, every hidden growth, passes to the next generation. The IRS collects almost nothing. This is the playbook. Buy your shares inside a structure that defers tax. Never sell them. Borrow against them instead, tax-free. Hold the whole arrangement inside an entity architecture that protects and controls. Die holding the assets. Let the step-up in basis erase the gains. Pass the wealth to your heirs. Clean. Buy, borrow, die. Academic economists have a name for the annual tax collected from the truly ultra-wealthy through this entire life cycle. They call it effectively zero. But we're not done. Remember the rules of the lab. We go backwards, all the way to day 1. So the final question is this: which decision, on which day, made this entire playbook possible in the first place? It was not the Tesla IPO. It was not the 2012 compensation package. It was not even the founding of Tesla. It was a decision made in 1995 by a 24-year-old man with $1,700, a rented office, and a single idea. He chose to start his first company, a web directory called Zip2, not as a sole proprietorship. He chose to start it as a C corporation. A sole proprietorship produces ordinary income, taxed at the highest personal rate. Every dollar hits the top bracket the moment it's earned. A partnership produces pass-through income, taxed in the same way. A C corporation, incorporated in Delaware, does something different. It creates a new legal being, a being that can own assets, issue stock, receive investment, grow in value over decades. And the person who founds it, instead of receiving income, receives equity. Equity that is eligible for the 83B election. Equity that can be held for over 5 years and potentially qualify for qualified small business stock, which excludes up to $10 million of gains from federal tax entirely. Equity that can later be pledged as collateral for tax-free loans. Equity that can be placed inside our revocable trust. Equity that can be passed at step-up basis upon death. Every layer of this playbook is only accessible to people who own equity incorporate structures. This is the dividing line of American wealth. On one side, wage earners, W-2 employees. They receive cash, taxed at full rate. No step-up, no deferral. Every dollar clipped by the IRS before it hits their account. On the other side, equity holders, founders, early employees, partners in funds, holders of real estate through corporate entities. They receive ownership, taxed almost never. Both sides may earn the same dollar amount in a year. Only one side keeps most of it. The playbook isn't hidden. It's written, in ink, in the Internal Revenue Code. It is simply designed for people who own things, not for people who are paid. So when Elon Musk walked into a Delaware filing office in 1995 and chose to incorporate Zip2 as a C corporation instead of running it as a freelance project, he didn't just start a company. He unlocked every layer of the playbook, 30 years before he would use any of them. Buy, borrow, die. It all traces back to one decision, one signature, one day. Here is the takeaway of case file number 1. The American tax code is not broken. It is working exactly as designed. It taxes income aggressively. It taxes ownership lightly. It taxes death almost never. Most Americans are playing the income game. They're trying to earn more, work more, get a raise. The wealthy are playing a different game entirely. They're trying to own more, acquire equity, build entities, hold forever, borrow against what they hold, die with it intact. Until you understand which game you're playing, you cannot win. That's the entire lesson. Everything else is footnotes. One last note before we close the file. Everything you just watched is reconstructed from public filings, journalism, and tax code. No private information was revealed. Musk has not violated U.S. tax law in any of the mechanics described here. Whether the law itself should exist in this form is a different conversation, one for voters, legislators, and citizens, not for a YouTube channel. My job was to show you the mechanics. Your job is to decide what to do with them. Some viewers will watch this and feel outraged. Good. Outrage drives reform. Other viewers will watch this and feel educated for the first time about how the game is actually played. Also good. Education drives opportunity. Both reactions are valid. Both are why this channel exists. Case file number 2 is already on the autopsy table. The subject? The Walton family. The question: how a single decision made by Sam Walton in 1953 allowed the most valuable retail family in history to pass over $200 billion to heirs across 4 generations with an effective estate tax rate in the low single digits. If you want to be there when we open that file, subscribe. Turn on notifications. If you learned something today, share this video with one person who still thinks billionaires pay the same tax rate as their accountant. This has been Dead Money. Follow the money until it stops breathing.